last week I skipped over this, not thinking about it. We have a new way of introducing bills for bill introduction. So I want to turn it over to David to kind of describe this new procedure we have.
Thank you, Mr. Chairman. Yeah, I mean, practically just the request for introductions they'll operate as they have in the House committees here for the past few sessions. According to the House rules, the individual that requests a bill through a committee must give their name, the individual entity they are requesting on behalf of, if applicable, and then they have to have that RS number from our office. That information will be displayed on the bill's web page on the legislature's website and should also be recorded in the minutes. That's how it's been in the past few years. What's changed this year, and you might have already seen it on some of the bills if you've seen the printed bills, is the requester information will now be printed on the committee sponsored bills below the sponsor line. So it'll be House Bill 2500 by Committee on Financial Institutions and Pensions, and then it will now say requested by an individual on behalf of, if applicable. So when making that bill request through a committee, please be sure that the request is clear and the requester provides the entity or individual they're requesting the bill for, if they want that to be reflected on the website and on that printed bill now. I might have to follow up with the requester if information was missed or if I need further clarification on an organization's name or an individual's name. Again, if there are any concerns or questions with the process, just contact me and then share and we'll get you squared away.
Are there any questions for David on that? Any clarification needed? Seeing none. Thank you, David, for that. One other piece of business I didn't cover last week. We have a new House email address for our committee. It is h.financial@house.ks.gov. And that will be a way for individuals to turn in committee testimony and all that. Rich controls that account as well. So anybody that has any testimony, please send it to that account. Again, it's h.financial@house.ks.gov. And it's on the committee page on the legislative website as well. So I want to make sure we get that covered. So we will go ahead and open up for bill introductions from the committee. Are there any bill introductions from the committee? Seeing none, are there any bill introductions from the public? Don't all jump at once, guys.
Be on. Michael Murray, the Executive Director of the Kansas Credit Union Association, requesting bill introduction for 24 RS 2294. It's a credit union statute modernization bill, and excited to talk with all of you about it soon.
Any questions from the committee? Any objection? Seeing no objection, it is introduced.
Thank you,
sir.
Brock Rayler, General Counsel for Office of the State Bank Commissioner. I'm requesting introduction to Bill number 24 RS 2454, which is a bill to modify the State Banking Code.
Any questions, committee? Any objection? Seeing none, that bill is introduced. Thank you.
Morning, committee. Mr. Chairman, Eric Turk here from the Kansas Insurance Department. I'm here to introduce a bill on the security side of our operation. The North American Securities Administrators Association Model Act to protect vulnerable adults from financial exploitation. The RS number is RS 2293.
Committee, any questions? Any objection? Seeing none, it's introduced. Any further bill introductions? Seeing none, we will move on. All right, committee, last week we heard from our friends on the banking side. This week, today we're going to focus on the credit union side, and we're going to call up first Jolie Murray, the administrator for the Kansas Department of Credit Unions. Jolie, welcome to the committee.
Am I on? Yeah. Good morning. Good morning, Chairman Hoheisel and members of the committee. My name is Julie Murray, and I'm the current administrator for the Kansas Department of Credit Unions. I would like to thank you all for the invitation to visit with you today about the credit unions that we supervise and our agency. Our credit union system began in 1929 in Kansas with the first credit union that was chartered to serve postal members and civil service employees, and that credit union is still in existence today. Our state chartered credit unions are exempt from income tax under the Internal Revenue Code, but they do pay sales, property, and employment taxes in the state. We currently have 46 state chartered credit unions with assets in excess of $7 billion. Our largest credit union is Credit Union of America in Wichita, Kansas, and the smallest is Catholics United in Hutchinson. I like to brag on Catholics United a lot. They are a credit union that sees what they do as a mission, and this credit union will provide its members very small loans. These loans are so small that it actually costs them money to make the loans for the members, but sometimes it's the difference between having food on the table or keeping the lights on. And that's what all of our credit unions are about. So I talk about them as much as I can. We still have 3 home-based credit unions in the state. Most of our credit unions were initially chartered with a specific field of membership to serve a group of employees, members by association, or geographic area. Our law allows credit unions to include all 3 within their field of membership. We do have 1 state chartered corporate credit union serving credit unions in Kansas, Missouri, Oklahoma, Nebraska, Colorado, and Montana with investment, liquidity, and cash management products and services. Our agency began in 1968 when the legislature approved the formation of a standalone agency for the regulation and examination of state chartered credit unions and removed us from the office of the state banking commissioner. The legislature requires all state chartered credit unions to pay an annual examination fee to fund the agency, thereby assuring our agency will be fully funded without the assistance of the general fund dollars. Our fees are remitted to the credit union fee fund within the office of the state treasurer, except for 10% of the fees, or $100,000, which goes to the general fee fund. Our agency is allotted 12 FTEs. The positions include an administrative specialist, an officer, 8 financial examiners. We have 2 openings in that area, 1 financial examiner administrator, and myself. Our law requires the department to examine every state chartered credit union at least once every 18 months to ensure financial stability and compliance with state and federal laws. Currently, our average period is a 15-month cycle. We do that just in case something has to move. We don't miss that 18-month statutory requirement. We operate and conduct our examinations under the standards that are equivalent with those established by the NCUA. We do that for consistency for our credit unions because the NCUA, as insurer, will come in and examine those credit unions at least once every 5 years. And so we want to make sure that we're keeping our credit unions on their standards. We conduct a risk-based examination. We evaluate the financial risk areas. We look at capital, asset quality, management, earnings, liquidity, and sensitivity. We assign a risk assessment between 1 and 5. I consider 1 the least financial risk and 5 the highest financial risk. It's not a grade. It's an assessment tool. Our teachers' credit unions have a hard time thinking they're being graded. Currently, we have 9 credit unions that are rated CAMELS 1. We have 24 that are CAMELS 2, 12 that are 3, and 4 that are CAMELS 4. 95% of our credit union assets are actually in CAMELS 1 and 2, which in my opinion is a well-run credit union. We have very little supervisory concern. The financial risk areas are established based on the examination team's assessment of 7 different risk areas. We look at credit, interest rate, which has been a hot topic this year, liquidity, compliance, strategic, reputation, and transaction. We partner with the NCUA to complete joint examinations for agreed upon number of credit unions each year, typically between 10 and 15 each year. We do a joint examination. They typically occur on credit unions of a specific size and a credit union that's got maybe some increased risk on their balance sheet, or if they haven't been in that credit union at least 5 years. So our agency challenges, we continue to see credit unions merge. What's happening is a lot of our smaller credit unions are struggling to find new managers when long-term managers retire. So sometimes merger is the only option for them. Another issue with our smaller credit unions is earnings. With the economy of scale, 2 small credit unions can join together and better serve a membership field. So we've seen about 2 to 3 mergers a year. To try and mitigate that, what we've done this year is we've started talking to our credit unions and specifically looking at their succession planning process. And as credit unions are different than banks, the board of directors and the supervisory committee are all volunteers. So we are talking to our credit unions about not just succession planning for the managers, but what about the volunteers? Because that's almost the hardest position to fill right now. We also struggle with staying abreast on the ever-changing business landscape. All of the new technology that the consumers want come with compliance requirements. They come with cybersecurity requirements. So staying abreast of all of that information and technology challenges our examiners. The rapidly changing economic conditions added challenges this year. Our examiners were expected to provide some meaningful feedback on interest rate risk, with the agency lacking a lot of tenure. So we had examiners have to come up to speed on capital markets very fast. We participated in additional training to meet these needs and will continue to do so. Information technology stays at the forefront of our focus. We're looking to find appropriate training for our examiners to increase their exposure in this topic. Last year, I didn't quite get to do a presentation last year, but last year the NCUA had worked to get an IT specialist in most of our bigger credit unions. So we felt fairly comfortable there. This year, they developed a tool that our examiners are using in our smaller credit unions, and it's scalable. So our $5 million credit unions can have a picture of what's realistic to provide security for their risk exposure in that. So our examiners are getting out in the field and using that with all of our credit unions. Our credit unions continually focus on the bottom line. While they're not for profit, they must have sufficient earnings to be able to continue providing member services. The economic environment has challenged that. The good news is that my CEO started talking about 2023 and about the middle of 2022. I started hearing it. They were having conversations, knowing what was coming and getting ready for it. This is an area that we're watching, but our credit unions have significant capital, and so they're able to ride out the challenges that this year's brought. Strategically, our smaller credit unions continue to look for ways to stay relevant to the members. With the changing demographics, the consumer behavior, they want things more technologically advanced, and our smaller credit unions can't quite afford that. So they're looking for other ways to make sure that they stay relevant to the members that they serve. Credit unions continue to focus on consumer lending. They offer secured loans, unsecured loans, mortgage loans, some member business loans. They offer checking, savings, share certificates, debit cards, and almost all of the same online technologies that our banks offer. I've got some numbers as of September 30th of 23. And these are just for the state chartered credit unions. So Michael and I were talking about a little earlier. He's going to give you different numbers, but these are just the state chartered, state licensed credit unions. Our credit unions' total assets were a little over $7.3 billion. We had a little over 500,000 members. Our largest credit union is Credit Union of America with $1.4 billion, and the smallest again was Catholics United. Catholics United is also our newest. They were chartered in 2005. Loans for the Kansas Chartered Credit Unions totaled $4.9 billion. Deposits are $6 billion. Credit unions' average delinquency did go up this year. We experienced some financial distress for our members, but we're still below the national average by a bit. We're about 125 basis points below the national average, so we're a little over 1%. And the net worth is at 13.71, which is quite a bit higher than it was last year. So that concludes my testimony, and I'll stand for any questions you might have.
Committee, any questions for Julie? Representative Mon.
I'm just curious. You mentioned the term home-based credit union. What can you just clarify that for me?
So we actually have credit unions that work. That the credit union office is in the home. They're small. They're all under $5 million in assets. We have one that's located on a farm site out by Beloit in that area, Glasgow. We have one farther out west and one in Kansas City. And so they allot an office area out of their home, and that's where they provide services to keep their overhead low because they're, giving the money back to their members.
So that's literally a home-based business.
Yeah, it really is.
Any further questions from the committee? I have one quick one. When we go back to the Campbell's rating, 11 rated 3, 2 rated Campbell's 4. Is that kind of in line with what we've seen, or is that a trend that shifted more towards?
So I'm glad you asked. The NCUA reported that they've seen a trend where they had an increase in 3s and 4s this year, and they actually had an increase in larger credit unions, 500 million and above. Our increase, what happened, if I looked at last year's number, we had 93% of the assets in 1s and 2s. Our assets in 1s and 2s has gone up. Our numbers, of 3s and 4s have gone up too, but they're smaller credit unions, and a lot of them are struggling with maybe income. But we're actually doing a little better than the national average. Mhm.
Committee, last call for questions for Julie. Seeing none, thank you so much.
Thank you.
All right, committee, next up we have Michael Murray, Executive Director for the Kansas Credit Union Association. He's probably going to tell us about the great K-State game last night.
Yeah, I'm happy to report that I had nothing to do with the color scheme of our post-merger Credit Union Association. Now that we're back to being the Kansas Credit Union Association, formerly Heartland Credit Union Association, but I don't know. I can just say maybe have it hand in it. It was a great game last night. Thank you for watching, and excited to see what the future holds. As he said, I'm Michael Murray, the Executive Director of the Kansas Credit Union Association. This is my second session in that role. I'm excited to work with you all again this year. In case you haven't met her yet, Emily Beam started with us on the last day of session in 2023. So she will be around this session, and then and as always, the credit unions are happy to partner with Federico and Durst, who might sometimes be around in the room, laughing at me fumbling around at the microphone behind me. So Julie gave a great layout of kind of the current market of financial services in Kansas for credit unions. I want to first start off by thanking everyone, and particularly this committee, for their work on ESG last year. There were a lot of proposals flying around, and I know that it's still a national discussion and potentially still more of a discussion here in the future. But the approach you took that did not put any mandates directly on private business to attempt to go right at the concerns by working with the state agencies, the state pension fund. I know that not all components were in that bill that everyone was looking for, but what we were hoping for at the time, and what I think is bearing out, is the aggregate effect of states passing similar ESG legislation to what was passed through this committee is having the intended effect of your largest financial institutions in the country, your BlackRocks of the world. They're certainly not bragging about any ESG investment anymore, and I think there's more and more evidence that that they are pulling back as well through their investments. I don't have the articles or testimony to forward to you right now, but as that comes out, I'm happy to point that out and talk with you as that moves forward. I'd encourage you to kind of to continue to see how that plays out based on what you passed last year, but happy to continue that conversation going forward. Yeah, Julie mentioned a couple structural differences between credit unions and banks and other financial institutions. The primary example that I like to throw out there is that we're a nonprofit cooperative model, much like your electric co-ops and your ag co-ops. And as she mentioned, there's the income tax exemption that credit unions do have. That's because of the structure, that nonprofit status, that the other restrictions to any field membership, being governed by a volunteer board of directors, locally owned and operated by the members of the credit union, and they return excess funds back to their members instead of their a board of directors or shareholders. For all those reasons, we just really see that there's kind of room for everybody in the financial services market in Kansas, between banks, credit unions, and other non-deposit holders and other private groups out there. Credit unions, we've consistently are making loans, nearly 100,000 loans a year to folks with credit scores of 640 or less. We're very involved in our, in the community in various ways, but in particular, we're proud of our involvement with financial counseling for both the youth and adults. And and sorry, didn't have coffee this morning, and wanted to throw out there that credit unions do in fact pay taxes. There's still the property tax, sales tax, other employment related taxes. That's at least over 30 million a year there too as well. And we're just we're happy to be here again this session, and look forward to working with you and talking with you more about the credit union statute modernization bill that's been put forward. We've been working closely with our regulators, with Julie and Gail. It's something that can benefit both private industry and our regulators that we have a great relationship with. Some of those struggles that she was talking about for credit unions aren't necessarily unique to credit unions. It's the same with the banks, where you have a lot of burdensome regulation placed at all levels of government. But that's particularly in our industry in Kansas. Our members have had a very good relationship with our state regulators. Any complaints that we fielded about any burdensome regulation that can actually run folks out of business from here and there, that's coming from the federal side. And so we're constantly working with our congressional delegation to try to find some more efficiencies there. But in the meantime, we have a great relationship with these guys, and that's kind of where this proposal was born out. And we'll be talking with you guys all more soon about that. So just thank you very much for the opportunity, and I'm happy to take any questions.
Thank you, Michael. Committee, do we have any questions for Michael? Representative Dodson.
Thanks, Mr. Chair. You had a piece in here on maybe restrictions on commercial loans in agriculture. Because there's two parts here. One is a LLC considered a commercial loan, and second, is that restriction based on a dollar amount out of the total assets of the credit union, or is it a ratio of some kind?
Right, and I'm not sure if you're talking about it was the 12.5% business lending cap. I'm not sure if that would impact. I mean, yes, as far as LLCs or. Okay, so sorry. Yeah, should. I'm sorry. I couldn't hear you. Sorry.
If you want to come back up to the mic.
Yeah, it shouldn't have an impact based on their asset size.
Okay. Just the language here is the federal member business lending law restricts our ability to lend to agriculture and small businesses by capping the amount of commercial loans a credit union can make. It's okay. I mean, if you can just.
Yeah. Could I get back? Yeah, could I get back to you about the specifics about that? But no, that's specifically for commercial loans, and I can get more information to you about the inner workings of it. But that's specifically for the commercial loans, not on the consumer side. And I can get you more information on that.
Thanks very much.
Thank you.
Committee, any further questions? Seeing none, Thank you so much, Michael.
Thank you very much.
Alrighty, committee. During the off session, we have a couple of joint committees that meet, and they issue reports, interim committees, and we're going to hear those reports now. Melissa, you're going to take both of them. Okay. We'll do the joint pensions one first. Is that fine? Okay. The first one will be the joint pensions, investments, and benefits report from that interim. Melissa, take it away.
All right. Thank you, Chairman Hoheisel. Committee members, as the chairman indicated, KLRD publishes reports associated with special committees and other study committees that are authorized by the Legislative Coordinating Council, as well as your statutory joint committees. These reports are published on KLRD's new website, which is https://klrd.org. And as of yesterday, we have 12 committee reports published. It was a very busy interim. There were 13 special committees authorized, and that's in addition to the 13 joint committees. The two reports that you're hearing today, one is from one of the most recent joint committees, the Joint Committee on Fiduciary Financial Institutions Oversight, and one is from the Joint Committee on Pensions, Investments, and Benefits. Turning to the committee report for the Joint Committee on Pensions, Investments, and Benefits, this is a rather lengthy report, and one reason for that is the committee is typically authorized to one meeting day. This year, given the number of topics submitted by the Joint Committee chairperson, the committee was authorized for 2 meeting days. And you'll see why, as you'll see the complexity of the topics discussed before the Joint Committee. Looking to the committee report, if you will look on the cover of that report, you will see the charge, that is the statutory assignment of topics to the Joint Committee. It is a 13-member committee that was created in 1992 and is authorized under KSA 46-2201 to monitor, review, and make recommendations relevant to investment policies and objectives formulated by the KPERS Board of Trustees, to review and make recommendations related to KPERS benefits, to consider and make recommendations on the confirmation of members nominated by the governor, review and make recommendations relating to the inclusion of city and county correctional officers as eligible members of KPNF, review reports regarding working after retirement exceptions, and to introduce legislations as it may deem necessary. Of interest to your committee, at the November 2nd and 3rd meeting, the Joint Committee received reports and updates and held discussion on the KPERS 2022 actuarial valuation, which you will hear about in more depth next week from Director Conroy, the KPERS budget and pension administration system modernization, the pension obligation bond proceeds, membership and retirement trends, investment performance, and implementation of 2023 legislation and law. Among those topics were working after retirement, the alternative investments cap removal, the deferred retirement option program, or DROP, the Kansas Police and Firemen's KPNF affiliation, and environmental, social, and governance investment policy and foreign adversary investments. In addition to these topics, the committee also invited comment from public retirees and held a discussion on KPERS Tier 3 adequacy, with comment from concerned parties and information from KPERS representatives on alternatives to or modifications for consideration. A review of KPERS law and legislation is found on page 4 in the right column. And in the committee meeting, Revisor Weiss summarized 2 bills that became law, and both of those matters went through this committee. The House Bill 2196, which relates to the affiliation of certain employees who are part of the Department of Wildlife and Parks into KPNF, and expanding the defined membership of the DROP to include any eligible member of KPNF, as well as extending the sunset date for that program. The second bill, and it has been referenced already today, was House Bill 2100, which created the Kansas Public Investments and Contracts Protection Act and an amended law governing the trust fund and investment standards to prohibit state agencies and other political subdivisions from giving preferential treatment to or discriminating against companies based on ESG criteria in the procuring or letting of contracts, to require the fiduciaries of the retirement system to act solely in the interest of participants and benefits of the system, to restrict state agencies from adopting ESG criteria or requiring any person or business to operate in accordance with such criteria, to provide for enforcement of this act by the Attorney General, and to indemnify capers with respect to actions taken in compliance with the act. Of news, both new laws had effective dates of July 1. This required immediate action by the Capers Board and staff, and those are detailed later in this report. The report also includes summaries of bills that received consideration during the 2023 session, including those to remove the statutory cap on alternative investments. And in this committee, that is House Bill 2103, and deferring to the Capers Board to establish the new limit, working after retirement measures, both of which were addressed in this committee, increasing the Capers lump sum death benefit in Senate Bill 256, which would have provided Tier 3 members with an additional 1.0% dividend interest credit for 1 year. Looking to the report again itself, the Capers actuarial valuation is found detailed on page 5 of the report. And the actuarial valuation report is a really significant report and helps set your consideration of measures that would affect the retirement system. It provides a snapshot of the financial condition of the system as of December 31st, 2022. It measures assets and liabilities and provides the basis for calculating future employer contribution rates. Executive Director Conroy indicated that all membership groups remain at the full actuarially required contribution rate, and that's a key factor in reducing the unfunded actuarial liability and improving the overall funded ratios for each Capers group. You'll see the key findings detailed on the right column of page 5. Among those, the assets. At the December 31st, 2022, the actuarial value of those assets totaled $26.5 billion. The actuarial assets are calculated by averaging or smoothing the investment gains and losses over a 5-year period. There is a net gain of almost $1.9 billion to be realized in the outlying years. The report also addresses the funded ratio and unfunded actuarial liability, and the overall funded ratio of the assets to liabilities increased from 71.6% in the 2021 valuation to 73.4%. The unfunded actuarial liability for the system declined from $9.8 billion to $9.6 billion. Significant factors affecting the unfunded actuarial liability in this valuation include employers contributing at that full actuarially required contribution rate and an investment from the legislature of $871.1 million in additional contributions that were included in 2022 Senate Bill 421. This is the first instance where Senate Bill 421's fiscal impact can be recorded because we're looking at the year ending December 31st, 2022. The contribution rates. The report indicates that those contribution rates for Capers State School employers increased from 11.42% to 11.56% for fiscal year 2026. Now, this is a difference from what we just observed in assets in the funded ratio, and that's primarily due to negative investment returns. The report beginning on page 5 and continuing into page 6 then details the status of total returns of 3 pension obligation bonds. And so what you will see are series 2004C, 2015H, and 2021K. Also detailed in the report are reports from the Capers Planning and Research Officer, and those relate to investment returns, plan maturity, and risk. And you will see that Capers is designed to account for its maturity risk through the use of those actuarially required contribution rates. Looking at page 7, this is when the Chief Investment Officer's report is included, and that's related to investment performance. What we learned for fiscal year 2023 is there was a positive return of 7.4%, exceeding the actuarial rate of return of 7.0%, but trailing that policy index or asset class benchmark of 8.4%. The portfolio's market value increased from $24.3 billion in fiscal year 2022 to $25.6 billion in fiscal year 2023. And there are some reasons. The CIO noted that they regularly conduct their asset liability studies and their long-term assets. And you'll see on page 7 in that bulleted list the recommended targets for the Capers portfolio. Fund performance was also reviewed, and you'll see 3, 5, 10, 20, and 25-year averages reported here in the report, as well as some economic and market observations in the right column on page 7. The report also details the operating budget for KPERS, as well as changes it wishes to make in its pensions administration system modernization project. And you'll see those beginning on page 7. KPERS estimates its expenditures will total $73.9 million in fiscal year 2024 and $82.6 million for fiscal year 2025. The majority of this is financed through the KPERS Trust Fund, and then general and investment related expenses compose the largest portion of the operational budget for KPERS. Benefits payments are considered non-expense items for budgeting purposes, and so they're not included when we look at operational expenditures. On the next page, you'll see information regarding the pension administration system, and you will see that KPERS started using its present system in 2005. That existing system remains capable of providing processes, but due to the required customization over the years, it has become less efficient and more unstable over time. So you will see activity from the KPERS board beginning in 2020 to study and look at design components for a new pension system. You'll see expenditures in 2022, reports in 2023, and finally in 2024, KPERS will begin implementation of the new system with an estimated completion time of 5 years. It anticipates modernization expenses that will total $9.0 million in fiscal year 2024 and $12 million for fiscal year 2025. All of these projects are financed from the KPERS Trust Fund. Beginning on page 8 is, again, some items very familiar to all of you, and those are some of the contemporary KPERS topics and issues that were discussed in the committee. That includes House Bill 2196 regarding changes to the Deferred Retirement Option Program, or DROP, as well as the KPNF affiliation by certain officers within the Department of Wildlife and Parks. And so you'll see information regarding how many members have participated in that program and the activities KPERS needed to accomplish prior to July 1. The next, also on page 9, you'll find information regarding the implementation of House Bill 2100. And that relates again to those investment guidelines by KPERS, as well as proxy voting and foreign adversary investments. You'll see that KPERS was required to engage a proxy voting advisor to manage and vote the retirement system's proxy ballots. And that was a role that was previously held by investment managers assigned with KPERS. Investment criteria, including the KPERS policy, was also updated, and you'll see information regarding the investments of foreign adversaries. The committee did receive a review of investments that were associated with a foreign adversary. The CIO confirmed that the system does have exposure to China and Hong Kong, the special administrative region, though the nature of that exposure has changed because of enactment of House Bill 2100, which prompted the system to exit 2 international equity commingled investment trusts. The system does own shares of 15 companies representing $365 million, or 1.5% of total fund assets. No stocks owned on the system are traded on China's A-share market, and the board also adopted new benchmarks to communicate those updated risk and return preferences to investment managers. Working after retirement is discussed on page 9, moving on to page 10. And again, those were measures discussed in this committee. Then the alternative investments cap. Both the Senate has Senate Bill 23, which was requested last year by the Joint Committee. The House Committee has also introduced House Bill 2103, and that relates to giving preference to the Board of Trustees to set a new alternative investments cap and to remove the existing cap that's provided by statute. The next page, page 11, also discusses a matter that's been before this committee, and those are cost of living adjustments. In this instance, we received testimony from public retirees concerning about some ways to modify benefits to counteract the impact of economic changes that retirees are facing. You'll see that we had a law enforcement representative who talked about the COLAs that have been implemented over time and the retiree purchasing power since the last COLA was initiated. The Coalition of Public Retirees and the Association of Retired School Personnel also commented on COLAs and interest in a COLA. The next item addresses the CAPERS 457 Deferred Comp Plan. And then finally, there is a special topic for discussion that begins on the right column, and that is CAPERS Tier 3. The Joint Committee over the past 2 years in particular has taken special interest in CAPERS 3 and concerns about equity and adequacy. And so information was invited to be provided from CAPERS on some alternatives or other ways to look at CAPERS Tier 3, as well as stakeholders who would have interest in changes to CAPERS Tier 3, particularly from the perspective of an employer using Tier 3 as a benefit to employees. And that included teacher representatives and law enforcement representatives, as well as a testimony from a local government representative. Finally, you'll see the review of alternatives that CAPERS provided regarding Tier 3, and then the conclusions of the committee. Those are probably best looked at in the box itself of the report. And so just looking at that box, you will see that there were several recommendations on these topics, including the creation of a joint select committee that would look specifically at the evaluation of Tier 3 and whether it is adequately meeting the needs of employees and employers. Also, on alternative investment cap removal, the committee is transmitting a message to this committee and to the Senate Financial Institutions and Insurance Committee regarding the need to address the present alternative investment cap and the delegation of authority to the CAPERS Board to establish a new cap. And the committee did recommend that that bill, once your action is taken, be made effective upon publication in the Kansas Register. There is also discussion of further study on working after retirement and recommending that study committees like this standing committee would work on a review of working after retirement rules, including those statutorily prescribed waiting lists, employer contribution rates, and the compensation threshold that's been specified, as well as current minimums prescribed for covered employees. And those would be both school and non-school employers. On the topic of the COLA, or the cost of living adjustment, the committee recommends that again, these standing committees review COLAs, including the input from stakeholders and the fiscal impact required if implementing a COLA. And then finally, the committee also recommends that the Appropriations Committee review using some of the projected state general fund surplus ending balance to make additional contributions towards the reduction of CAPERS unfunded actuarial liability. Mr. Chairman, that is the report from the very busy Joint Committee.
Thank you for that breakdown, Melissa. Before I open up questions, Melissa, do you want to get a drink?
I think I'm all right. Thank you.
Okay, no problem. Any questions for Melissa on that one? Oh, I'm sorry, Representative Weigel.
Thank you, Mr. Chair. Thank you for your report. I have two quick questions on page 5. SB 173 would increase CAPERS lump sum death benefit from 4,000 to 6,000. How did they arrive at that? Do you know?
That bill has not yet had a hearing. I think it was just an interest in providing some sort of index or increase that would be more appropriate than the $4,000.
I'll check with them.
Yeah.
Thank you. And the other question is, as far as with the ESG that was passed last year, do you have, I don't know if I missed it or if it's not included in this, what the total cost is going to be to CAPERS each year for the hiring of the person that's going to be in charge to oversee that, and how much administrative costs are going to be involved each year that's going to be attributed to the CAPERS fund? Do you have a number?
I know that they addressed the fiscal note that had been originally provided. It was lower than that amount, but we can ask Director Conroy to provide that information in his presentation.
Yeah, we'll have Director Conroy here Monday.
Okay.
I can tell you though that it came in significantly lower than what the original fiscal note was, the cost. So Director Conroy will have more on that Monday though.
All right. Thank you. Thank you very much. Thank you, Chairman.
Any further questions, committee? Vice Chair.
Mr. Chairman, just point of order for our members. The Capers Board meets this week, tomorrow and Friday. If you're interested, we can get you the link, or you can attend in person if you're here in Topeka.
Definitely interesting meetings. Vice Chair and I and ranking, we've attended them via Zoom or in person, and they're very informative. So, seeing no further questions, we'll move on to the second report.
Okay, the Joint Committee on Fiduciary Financial Institutions Oversight. As I mentioned, this was one of our 13 statutory joint committees and is one of the two most recent, having been created by 2021 law. And statutory joint committees typically monitor functions of government, agencies, or funds. This committee monitors the state's single chartered fiduciary financial institution that's also referenced as a TEFI. So I'll be using TEFI or TEFI Act to speak to the law that governs the TEFIs. So what is a TEFI? Probably most helpful is to begin with a working definition and that regulatory oversight that was established in 2021, House Bill 2074, that's also now referenced as the TEFI Act. First, what it's not. And so unlike banks and credit unions that you've heard about in last week's presentation and today's presentation, a technology-enabled fiduciary financial institution, or TEFI, is not a depository institution, nor does it provide traditional banking services. So the law that's created here has created a separate and unique lane for the regulation of TEFIs by the Office of the State Bank Commissioner. And that is that Kansas is the only state that has a full regulatory scheme for TEFIs. So a TEFI provides specialized financing that's collateralized by alternative investments to customers who are located primarily outside the state of Kansas. And it's through this technology-enabled platform that most of these FIDFIN, or fiduciary financial institutions, transactions take place. And so those could be either in whole or in part conducted on the platform within the state of Kansas. So similar to a more common trust arrangement, this is an alternative asset trust arrangement. So in these arrangements, investors transfer their title to their own alternative assets to a regulated trustee to allow fiduciary management of those assets or to maintain liquidity in exchange for assets. Under the TEFI Act, alternative investments are professionally managed assets that are not publicly traded and could include private equity, venture capital, leveraged buyouts, private debt, structured credit, and real estate. In terms of intangibles, then, one of the greatest assets of that TEFI is its technology-enabled platform. So how is a TEFI associated with an economic development in Kansas? Under the TEFI Act, some of the revenues from those alternative asset financing fees, or what are termed as FIDFIN transactions, are directed into an economic growth zone here in Kansas and other programming for economic development. Senate sub for House Bill 2074 is not only established the regulation of fiduciary financial institutions, or TEFIs, in Kansas by the Bank Commissioner, but also legislative oversight. And that just created this 9-member joint committee, and the role is further explained on page 3 of this report, and includes monitoring, reviewing, and making recommendations regarding fiduciary financial institution operations in Kansas, and receiving a report from the Office of the State Bank Commissioner, including any recommendations for legislative changes necessary to implement provisions of the Act. The report summarizes presentations by the Office of the State Bank Commissioner, or the OSBC, and the state's TEFI. Identified in the TEFI Act as beneficent company LP, which is generally referred to as beneficent or BEN. When referring to the chartered fiduciary financial institution, you will see this report using Beneficent Fiduciary Financial LLC, or BFF. So also included in this report are economic development and grant programming updates provided by the Department of Commerce. The LCC authorized this committee to meet for 1 day, and it met on November 7th, 2023. You will see the committee activities detailed on pages 4 and 5 of the report. There's an outline of one bill that was passed by the legislature regarding fiduciary financial institutions, and more broadly, financial institutions information security. That bill went through this committee. Additional legislation considered by the 2023 legislature addressed fingerprinting and state national criminal history record checks relating to those officers, directors, and organizers of a TEFI. as well as adding the definition of qualified charities within the TEFI Act, that was Senate Bill 204, and House Bill 2133, not this committee's version of the bill, which related to credit and debit card surcharges, but the Senate committee's version, which related to the consideration of a TEFI as a chartered trust company under the oversight of the State Bank Commissioner. And there were 2 additional bills introduced in the Senate, but those have not been scheduled for hearing. Turning to page 5 of this report in the right column, you'll see 2 reports that are really central to the Joint Committee's oversight, and those are the reports of the OSBC and BFF. Among the topics of interest to this committee is in the Commissioner's update were examination and oversight and the unique role, regulatory role, and really that is the absence of a federal regulatory counterpart assigned to the State Bank Commissioner. The Commissioner's examinations to date are detailed, along with regulatory concerns regarding the inability to conduct a safety and soundness examination similar to those that are currently utilized for banks and trust companies, as well as those that were described for credit unions today. Then there was also cited was the TEFI Act's disallowance of an examination to consider earnings as a component and the assignment of goodwill assets as a capital component. The Commissioner also provided an update on the ongoing challenge to secure certain background checks, and legislation is anticipated this session to assist agencies, including the OSBC, in complying with federal Bureau of Investigation standards. Comment was also provided regarding BFF's parent company, Beneficient. Representatives of BFF and Beneficient also detailed their goals and operational achievements. Those are spelled out on page 7 of the report. It was noted that Beneficient did transition from a private to publicly traded company, as had been discussed in the Oversight Committee's meeting in December of 2022. And so there are limitations in place regarding the information Beneficient could provide. And that would include information such as company stock, pending plans, or planned initiatives. The conferees highlighted the completion of their examination cycle with the OSBC and reiterated the overall framework established in the TEFI Act and the Joint Committee's oversight is working. The first paragraph there details BFF's operations and also includes discussion in response to some of the concerns that were detailed by the State Bank Commissioner. The BFF report also addressed the next steps following the completion of the pilot program, the issuance of charter, and the examination cycle. And that will include the review of proposed regulations and any legislative changes needed to bring this alternative asset management industry forward. The report also highlighted the economic impact of the TEFI Act, and namely that is the statutorily prescribed distribution of FIDFIN transaction fees that are set aside and held in a charitable foundation. Under the TEFI Act, that is a qualified charity, and it is Beneficient Heartland Foundation, which is based in Heston, Kansas. To date, there have been a total of $16.6 million in assets that have been assigned. Among those monies is $2.7 million that are over to the Department of Commerce's SEED program and $8.1 million to Harvey County for the Economic Growth Zone funding. And projects in that zone are detailed on page 8 of this report in the right column. Finally, there is a summary of the presentation from the Kansas Department of Commerce on this Strategic Economic Expansion and Development, or SEED grant. The program's purpose is to support the economic revitalization of Kansas communities that are under 5,000 in population, and that's within the 78 counties that are designated in the TEFI Act. A second round of SEED funding was announced in August of 2023, and the department conferee indicates the agency received 68 applications and to be addressed by available funding of $270,000. At the time the committee met, it was noted awards would be anticipated in December of 2023. We did include information to let you know that there are 13 recipients who were selected to receive nearly $275,000 for investments across those communities. And the department did issue a press release. We're happy to share with you what communities and projects were awarded the SEED funding both in the first and second rounds. The final element of this report is the conclusions and recommendations that were submitted to the legislature and specifically were requested to be sent to this committee. And that includes some interest in an advisory group or council. So the committee acknowledged in its report this unique regulatory framework that establishes TEFIs and it's the monitoring of those in Kansas. Now that there is experience gained from the pilot program, the examination cycle, and the dialogue with the committee, the Office of the State Bank Commissioner, Beneficient, and the Kansas Department of Commerce, the committee is interested and expresses its support for the creation of an advisory council that would add an additional perspective on future regulations and TEFI activities, alternative asset industry features and standards, and the promotion and marketing activities to help secure future investments in Kansas and its communities. And this could include future TEFIs, in addition to the currently chartered TEFI. The Advisory Council should also include among its advisors experts who are familiar with federal regulation and oversight, and academics who are familiar with the industry as well. The Joint Committee encourages the formation of this advisory ad hoc group, and that was terminology the committee wished to use because it would not be a legislative committee, it would not be a statutorily authorized committee, nor committee members would receive compensation for participation. This was simply meant to be an advisory group that would dialogue both with the relevant standing committees of the legislature and this joint committee. Mr. Chairman, that's a review of the activities of the Joint Committee on Fiduciary Financial Institutions Oversight, and I'm happy to stand for questions.
That, Melissa. Committee, any questions for Melissa on the second report? Vice Chair Clifford.
Thank you, Mr. Chairman. Thank you for an excellent report. When the Dodge City Casino opened up, there was a charity called the Mariah Fund that was established, I believe, under statute. The business entities have since abandoned that charitable organization and are dictating where the funds go. We have created here the BHF, and I maybe not here, but I would be interested in knowing if the act makes this in perpetuity or somehow protects or lock boxes this charitable BHF, where somehow it disappeared in Fort County. I don't know if you could address that now, but that would be of interest to me. Thank you, Mr. Chairman.
I'll address it in part, and then I think I'll visit with David to see if there's anything more formal in the TEFI Act. It is anticipated the economic growth zone is very clearly identified as a community in Harvey County of 5,000 or less, which then puts Heston into that position for those qualified distributions. And that was what was intended with the first TEFI. The Department of Commerce then would also be able to allow additional funds to come out of there's a fund that's set up for economic development that could also be used. The act does not speak to what might occur if there were future TEFIs or if those economic growth zone changed. So I think that might be the difference. There is also a very specific report that was provided by BFF from the Heartland Charitable Foundation. So there is an audit that's done each year. And so that report was made available to the committee and is public.
David, do you have anything to add? Or are you still looking into it? We can get an answer at a later time if you would rather do that. Vice Chair, acceptable?
Thank you, and thank you for your answer. Thank you, Mr. Chairman.
Any further questions for Melissa? Seeing none. Thank you so much, Melissa. Committee, I'm going to open up bill introductions again. I see we have Representative Epley here.
Thank you. House Bill 24 RS 2362, again, on behalf of the Retired Teachers Association of Atchison. It is an act concerning retirement and pensions relating to the Kansas Public Employees Retirement System and systems thereunder, authorizing a post-retirement benefit payment to certain retirants. Thank you, Mr. Chairman.
Committee, any questions? Any objection? Bill is introduced. Thank you, Representative. All right, committee, that concludes our work for today. We are meeting Monday. We'll start getting into the Capers topic. And I do want to just give you guys a heads up. Next Monday, we will also hear HB 2103, That has to do with eliminating the statutory 15% alternative investment cap within Capers. We heard this last year, and I kind of want to do a refresher. I'm planning to do final action on this next Wednesday. So I want to give you guys an opportunity to have a refresher when Alan is here. Alan will explain Monday why we're trying to move this along pretty quickly. They're basically up against that 15% cap now. So we need to try to get this moving along and get it in the statute book as soon as possible. So that's why we're going to hear it Monday when Alan's here. Again, we heard it last year, and then try to do final action next Wednesday on it. So if anybody have anything else for the good of the committee? Seeing none, we are